Well, I think if you look back over the last 10, 15 years, when new innovations, new technologies have come into the world, the market in the earlier days has consistently undervalued them. Look at how Google traded. Look at how Meta traded in their early days. Look at how Netflix traded, even though we all thought they were highly valued and perhaps even overvalued. And I think the market has become accustomed to, particularly in periods when risk is valued, in reaching from a multiple point of view and a multiple of earnings point of view for these high growth and really strong market position companies. But it's still
Ralph,
scary.
What does it say about... Well, okay, so why is it scary? Does it remind you of 2000? Does it remind you of a previous era? What is it that scares you about this?
No, I don't think we're at the world of 2000. I mean, you looked at some of the companies then, there were companies that had literally no earnings nor any prospect of having earnings, and they were valued at multiple $billion. I remember looking at a company that's a terrific company, Cisco, and in 2000, it was valued as if it would capture 150% of the router market.
Wow.
So, that's just not possible.
Right.
And I don't think we have that kind of froth in the system right now. If you look at the multiples of the Magnificent Seven, in large measure, they're fact and earnings based, not hope based. And so, the overall valuation of the market is not, it's not cheap, but it's not way stretched either. And as rates have come down, the valuation has become a little more reasonable.
So if I said to you that the Fed's going to cut 7 times this year, buying tech makes sense?
Well, I don't believe that's going to happen.
You don't? Okay, what do you think is going to happen?
So don't tell me that.
What do you think is going to happen?
I think the market is over expecting interest rate cuts by the Fed. And by the way, if we did have 7 interest rate cuts this year, that would be a bad thing, not a good thing, because it would be the reason they would cut that much would be that they're seeing real weakness in the economy and that the employment part of their dual mandate was at risk. And we don't want that. What we want, and certainly what the Fed is hoping for, is a continued reduction in inflation without too much erosion in the strength of the employment markets. And, if you look at 2023, you'd have to give the Fed a pretty damn good grade for what they achieved. If you were sitting here in January of 23 and said we would end the year where we're ending now in inflation and employment and unemployment, everyone on the planet would have said, sign me up.
Yeah.
So.
What do you want to own in that kind of scenario? If we get a soft landing, if the Fed can deliver and continue to deliver an economy that is seeing full employment, we've seen the claims numbers this week, they're stunning, and sees inflation coming down. We've just seen the University of Michigan numbers come in as well. Consumer feels good, inflation is coming down. What do you want to own in that kind of scenario? Is it big tech, or is this the environment in which the market should, in theory, broaden out?
I'm a believer that at some point the market does broaden out. There are a lot of great companies that are actually trading at discounts, and in some cases significant discounts to the market multiple. I think small and mid-cap companies have been left behind a little bit, and I think that's particularly the case when you think that small and mid-cap companies tend to have a little bit higher proportion of their sales domestically in the U.S. And the U.S. economy is clearly the outperformer. The trend, and I'm not sure I necessarily am a huge supporter of this, but the trend is definitely in more trade barriers, less flow of goods and services across the border. that's something actually that should benefit the Russell 2000 relative to the S&P and the NASDAQ 100.
So does that mean that if I'm at the Fed, that it's a possibility that there won't be a landing, but that won't necessarily mean the Fed's going to have to hike or that we're going to see a massive acceleration?
I think the probability of the Fed hiking at this point is very, very low.
But we could not land. Things could just bump along okay.
Yeah, I mean, if you ask me what do I expect to happen this year, I think inflation continues to drift down much more slowly than it came down in 23, but the general trend will be positive. And, the range of, I guess recessions are judged by GDP growth is, down a little bit to up to 2.5%. So it's a pretty narrow range unless we get a serious exogenous shock, and we've had some which haven't really affected the market. So I think you can never be totally relaxed on those things because we never see them before they happen. But in the absence of that, I think the band of activity or expectations for the economy this year is relatively narrow.